Let's take the conversation forward and welcome on board Trideep Bhattacharya. He's the CIO-Equities at Edelweiss Mutual Fund as well. Trideep, hi, good to connect with you. Wanted to begin by asking you your market outlook at this point of time. Are you in the camp who believes that the rally is not done yet? Or do you expect that there's going to be a bit of a consolidation, a bit of sideways move, and we're not in for a runaway rally?
Good afternoon. Thanks for having me on your show. And I would say that in the near term, we would expect the markets to be volatile. Wouldn't like to sort of, quantify what number this at. And the reason why we think the markets are likely to be volatile is because, overall, if you look at the interest rate inflation quagmire, we haven't been able to surpass that as yet. While yes, we are closer to the peak of interest rates, and some people, gesticulate that we hit the peak. I think the downtrend with regards to interest rates, in my opinion, is going to take a little longer than what people anticipate. In other words, inflation probably might turn out to be a little more stickier than what people think about. But in the near term, for this volatility actually kind of masks the strength that India Inc. at the moment is in the middle of, which in my opinion is a multi-year sort of positive trend, particularly from a 2 to 3 year perspective. So I think I would use, if you look at last 12 to 18 months, broadly speaking, markets have been kind of, flattish. I would probably see this kind of flattishness, if I may call it that way, or volatility continue as we head towards maybe the year end. But I would encourage investors to take this as an opportunity to kind of get invested, because the medium term, from the 2 to 3 year perspective, for India Inc. Is looking particularly robust, and we can go into detail on that. But that's my near-term prognosis.
Okay, so volatility is here to stay. That's your friend in the markets at this point in time, because that is what is giving you opportunity. And I like the point that you talk about inflation, that it's going to be sticky, and that's quite evident with the recent moves coming in from the central banks, whether it was Bank of England with that 50 basis point hike, Turkey hiking by 650 basis point, and of course the Swiss central bank as well yesterday. But Trideep, the texture of the market seems to be changing a bit, in the sense that it's the mid caps and small caps that was leading the last rally in the last 1 month or so. Versus the large caps, the likes of your HDFC Bank, Reliance, etc., they weren't participating. Do you expect that trend to continue for the rest of the year?
I think the outlook for mid and small caps is more favorable than where we were about 6 months ago. And the reason I say so is because of three reasons. First of all, the valuation differential against the mid and small caps, which used to be the case earlier, is no more valid. In other words, the valuations of mid and small caps are a lot more comfortable as we speak. And particularly after having seen a good round of correction over the last 12 to 18 months, whereas earnings have grown, valuations are more reasonable. The second is the valuation differential between large and mid and small have also kind of, and moved to a level which is in sync with their 10-year average. So on net balance, the valuation picture with mid and small caps have started to become comfortable, which is why we've been sort of talking to clients a little more positively on mid and small caps over the last few months. Going forward, we expect a little more balanced outlook. In other words, outlook towards mid and small cap could probably be better than where we have been in the past. So yes, I agree with that view. Incrementally, a little more positive on mid and small caps, but in general, in the overall volatility, I would still look at mid and small cap with a 3 to 5 year outlook, rather than trying to time the markets and be really short term.
Trideep, I see in your mid-cap fund, and that is what we're talking about, there's a lot of capex kind of plays, whether it's ABB India, whether it's Cummins India, or even the likes of KEI Industries, etc. Is that a theme that is one of your top bets?
Absolutely, and I think you hit the nail on the head. Good analysis. So I would say that one of the top themes that over the medium term that we are betting on big is basically the private sector capex cycle in India. We think for the first time in the last 10-12 years, given that the capacity utilization in India Inc. It has reached about 74-75%, and corporates have delevered over the last 4 or 5 years, which means they have cash in their hand. A confluence of these two makes me feel that over the next 3, 4, 5 years, we would see a good round of capex cycle driven by private sector come through. Something that we haven't seen in the good last decade or so. And I think, given that be the case, every subpart of capital goods, whether it's industrials, whether it's EPC, whether it's contract, would actually see their time in the sun. So we are quite big believers in the private sector capex cycle. Also, the second area which I would like to point out is defense. I think the indigenization of defense is the second theme that I would sort of point out to yourself is a multi-year theme. We are quite positive, and you will see quite a few holdings of ours in the portfolios. And we think there the story has not even started. It's just about kind of getting warmed up. We think it's a 10 to 15 year theme, and a lot of companies would make a secularly more money over a period of time. Of course, there will be volatility, but these would be two areas under the heading of industrials, capital goods, or capex that I would like to point out we are betting on, and we're certainly positive on.
So that's the word coming in, defense. Despite the recent run-up that we have seen in some of these stock prices, the story is much more long-term, 10 to 12 years. The other theme that I'm spotting, Trideep, in your holdings tells me that you're quite positive on the real estate and you're playing it through building materials. Again, the names like Astral, Century Ply, Kajaria Ceramics, they come to mind with respect to your holdings. What's your view on real estate, and why not directly play it through real estate, and why building materials?
Excellent. In my opinion, the real estate sector is in middle of bottoming out. And this, in my opinion, is the first couple of years of a 5 to 7 year trend, particularly in residential space that we have spotted and we are betting on. What we noted about 6 or so months ago, that overall the unsold inventory across the country had reached a 10-year low. With inventory at so low, and kind of overall people's appetite gradually kind of increasing towards housing, we certainly spotted that the residential housing could be a good place to be, particularly having seen this consolidation in and around RERA and whatnot. Now, since we say about a 5 to 7 years being, there are two ways to play this. One is the direct way, which is, as you said, the real estate plays, or the indirect way, which is the building materials, the tiles, the cements of the world and whatnot. We prefer to go the building materials way, even though we do have a few holdings in direct real estate, because we think that the pricing power and the quality of businesses that we get on the indirect plays is a lot better. And certainly augurs very well for minority shareholders like that of ourselves. Hence, our portfolios are quite populated with a whole bunch of indirect plays like building materials, where brands, etc., become more dominant aspects, along with maybe one or two direct plays as well. So that's how I would answer your question.
Pradeep, just talk to us about IndusInd Bank, if you can, in terms of stock-specific action. If not, at least the mid-cap banking names, whether it's IDFC First Bank, IndusInd Bank, they are the ones which are, kind of leading the race going forward as well. What's your take on the mid-tier banking space now?
So first of all, to set the context, we are quite positive on lending financials. We think after having seen a strong NPA cycle behind us, after having seen through the corporate deleveraging cycle, I think the banks are in a bit of or banks or lending financials more generally are in a bit of a sweet spot, wherein the credit growth in the economy is picking up and the asset quality worries are behind us. So not only private sector financials, but also public sector lending financials are looking kind of, looking to be good from a 1 to 2 year perspective. And if you add on top of the fact that the valuations of this particular subsector is quite favorable, particularly in the context of the other themes that we talked about, that makes lending financials one of our favorites. Now, as we deep dive into lending financials, particularly with regards to mid-cap names, we find a dearth of quality financials in that perspective. And I think, and hence, the ones that they are will certainly see a better days in front of us going forward. So we are on net balance, we are quite positive. Lending financials, both large and mid-cap, maybe off late a little more NBFCs than banks, but net still quite positive on the space.
Quite positive on the lenders, NBFCs over banks, defense is one space that you like, real estate through building material, lots of takeaways coming in. Thank you so much, Trideep, for joining us today and talking to us about your outlook.